That's great. Like we have our first guest in the room. So let me go ahead and admit her.
All right.
Hi, Eileen. Eileen, happy Tuesday. Thank you for hopping on.
Hi, Jenny.
Ellie invited you, right? Or
Yes, yeah, she's a college friend of mine.
oh, good. So you went to USF.
San Francisco State
Oh yeah,
University.
yeah, San Francisco State. Yeah, I always get the mixed up.
That's okay.
Yeah. What do you do now for work?
So I work in HR consulting, but specifically compensation.
Oh, nice. Yeah, that's definitely very helpful. At a tech company or what kind of company?
It's HR consulting, so it's interesting because so my company is Gallagher, and they're
Mm,
mostly known on like the insurance broker side or like
mm,
risk management. So if companies need like help with their benefit plans, like what medical, dental, vision, and those types of benefits they need for their company, my company helps with them, but they have like a HR consulting division within the company. So I'm part of uh, that division for my company.
I love it. Is it based in San Francisco or?
It's international, but we do have some Bay Area offices, so San Francisco, Walnut Creek.
Mhm. And you're in San Francisco now still or out in East Bay?
No, I'm still in San Francisco.
Oh, good. Big. And what are some of your goals and what do you want to learn today?
So me and my husband, we got married in August last year. And so we're kind of taking our first year to like enjoy while we can before we decide to like start our family. But then at the same time, it's also thinking about having more space. So because we already know that the space we currently live in is going to be hard once we start our family. So we've started having conversations about how it would be like trying to find a home. But I think the financial part of it is where we're having difficulties, especially with how much mortgage is nowadays and like living in the Bay Area. So I reached out to Ellie and she was the one that actually shared about this webinar. So I'm hoping like the resources and tools could be a starting point for me and my husband.
Yeah, we have Assad here, who's our financial guru over at US Bank. So it would be we're going to go over a lot of information, but I think we're
Mhm.
going to have a tight knit group here today. So we want to cater it to you and maybe a few others who come, but definitely we can dive into your numbers and give you an idea of what you can
Mhm.
afford, what you might need to save and such. But
That's
thank you for
great.
much of the background. And Christine is my partner here. So we work very hand in hand. Ellie's still kind of going back between East Coast and Bay Area, but
Mhm.
it would be probably helping you with the home search.
Thank you.
Yeah, perfect. And what's your husband's name?
Jonathan?
Jonathan. Oh, great. Perfect. So, yeah, we would love to meet you and Jonathan and in person and walk
Mhm.
us through. And you guys are renting right now?
We currently live at his parents' place. So they have 3 floors, but the bottom floor could be um for like someone that's renting. So they used to have a family that rent the bottom floor. And it's almost like a studio. It's one bed, one bath. Which works for us now, but then like eventually, we need like a bigger space.
Mhm. Yeah, definitely got to expand. Any family planning for you?
hmm Yeah, so that's kind of hoping that like that's kind of the worry too, because if we start our family, like it's gonna be hard with the space that we have right now.
Mhm. Yeah. Well, let's definitely get you more space. Don't want
Yeah.
you to room throughout the whole night. And perfect. Um, we'll probably just go ahead and get started. And then Christine, I'm gonna give you co-host access so you can let other people in. But we'll just quickly do an introduction of ourselves. So I'm Jenny Locke, founded Zenco's Homes and went to Marshall School of Business. I bought my first home in um, at the age of 23 years old. And we've been helping many families across the Bay Area with their real estate goals. So over 500 families helped, probably close to 800 now, and also throughout the Bay Area. I see Phil just joined. So welcome, Phil. Hi. So we're just starting with some introductions. And Phil, if you want to quickly hop off and introduce yourself and see what you want to learn today.
Sure. Hi, Jenny, and glad to be on the call. Just want to learn a little bit more about the whole process of buying a home. Still, I have something, but I'm still fairly new to the whole process.
Okay. Where are you based out of, Phil?
San Francisco.
San Francisco. Great. So you own something in SF and want to get something else?
Yeah, yeah, exactly. And maybe out of state, maybe in California. I'm not too sure yet.
Okay, perfect. Well, we're the perfect team to speak with. Assad, our lender here, he is licensed and can loan in all 50 states. I own properties in Bay Area, California, in Utah, Texas, Tennessee, Alabama, Missouri, and Hawaii. I think those are the current ones right now. And Christine, she has property out in Yosemite and knows about like investing in like Airbnbs and those type of properties. So we'll be able to share a little bit more, go into the finances today, and see what that would look like. A quick introduction of our of us. We also have a company called Zenco's University where we educate people on how to build your mindset to build your portfolio through real estate, build your net worth, build passive income. So Phil, if you're looking for out of state property, Eileen, I know you're starting with your first home, but hey, how can we build equity? I bought my first home at 23 years old in South San Francisco, did something called house hacking, rented out rooms. And for Eileen, similar like what your family is doing, like you're kind of house hacking them or you're their renters where you pay some rent to them and they're able to offset their mortgage and be able to scale and grow. So now we own now over 300 units across the country and collecting about $30,000 per month plus in passive income per. So that's varying from Airbnbs, short-term rentals, long-term rentals, commercial properties, and some in the Bay Area and some out of state. So we're excited to educate people on the different mindset here. So yeah, first home I bought here was this nice 4-bedroom, 2-bath in 2016. So we're going to share about the power of real estate. I bought this for 870,000 for the purchase price back then and put 400,000 from a home equity line of credit from my parents' house. My parents are immigrants. They worked in a clothing factory, didn't really make much, but they knew even when interest rates were like 13, 15%, real estate was really powerful. So they put all they could and bought a home, and eventually that home built equity, and over time, over 20, 30 years, was able to pull that home equity line of credit 400,000, even them making basically less than minimum wage in their job because they're paid per item. And then what I leveraged that as a down payment, and then got another loan for 470 to be able to purchase this house at the age of 23 years old, and house hacked this, and this covered the mortgage, and then was able to do a cash out refinance in 2020, actually with Assad, right before COVID or right around COVID. And then the value jumped up to $1.23 million. So almost 350 plus $1,000 of equity built in just in yeah, 4 years. So making almost 80K per year by just living in a home. And my friends and colleagues at the time were paying down my mortgage. I was living basically rent free, and was able to do a cash out refinance. What that meant was pull out that money, paid off the old loan, got a new loan, and converting this house to a short-term rental. So now it's cash flowing, making several $1,000s per month, and then was able to scale and buy more properties across the nation. So this one's out in Utah with my good friend Kyle, and now leveraging in all these different states. So we have cash flow and created our own retirement plan and future for our children's college education. So people think, okay, like maybe 529 plan or investing in some other stocks to fund for college education for their kids. But for me, I'm like, I want to buy property because then the tenant is going to pay it down. And then there's just so many tax advantages of owning homes. And then by the time that when they're 18, 19, 20 in college, it'll be mostly paid off. And then being able to have them decide what they want to do with it, if they want to keep it for cash flow to pay for their books and food, or do sell it to be able to pay for special education or something. And then in 2020 was actually able to buy my dream home and move my parents out here to the Bay Area from New York. As I mentioned earlier, they were immigrants working full-time in a clothing factory, less than minimum wage. So was able to really scale up into a bigger home through real estate. So Phil, having already owned a home and probably thinking about that process, hey, I want to upgrade and scale my property, there's great tax deductions that we'll talk about of what leveraging real estate will do for you. And here's some of our team members. Here we have Christine on the call, and Eileen, you know Ellie. So she works with us coincidingly East Coast and West Coast, but we have a whole task force of ladies to be able to help support you on your search, whether you're looking here or, and then we have our like Veronica and Pauline, who are actually based in the Philippines, and they help with supporting a lot of the back end support. But with our dynamic team, we're able to help over 100 clients every single year with their real estate goals. So we're excited to help you guys, Eileen and Phil, and anyone watching the recording. So some of the benefits of owning real estate is happiness. Look at all these happy families. One of the recent ones on the top left and bottom right is Christine and I helped my good friend, who's actually a roommate. I was house hacking in the Bay Area and rented out, and she was able to buy her own home pretty recently with her new husband. And you just can do whatever you want to the home. You can decorate, you can have your screaming, crying baby in the future and not have to worry about people upstairs or downstairs. And you can paint the walls whatever you want and do whatever you want to the home versus having to ask your landlord. And the tax advantages. So the benefits, it's you can deduct $10,000 from your property taxes per year from your income, and then up to $750,000 of mortgage interest deduction. So that could be close to $30,000 to $45,000 deduction per year. So let's say if you're making $200,000, then 40,000 deduction would be your income will be based off 160. So you're saving on taxes of $40,000 times your tax rate, which is about 35% on average. And then the power of home ownership of primary residence. So Phil, we can dive into a little bit more, but if you've owned your home for some time and built good equity on it for a primary home, there's something called tax-free capital gains of $500,000. What that equates to is about $800,000 of tax-free income. Tax-free income of like the gain. So let's say if you bought a house for 1.5 million, you sell for $2 million, that 500,000 is completely tax-free, which equates to working, like if you're making $200,000, equates to working 4 full years of a taxable income of 800,000. So it's 250,000 per person, and then for married couples up to 500,000. So Eileen, I think it's a great option for you. Hey, let's just start something, maybe start with like a 2-bed or 3-bedroom home. And then as your family grows bigger, then in 5 to 10 years, it'll grow in value, and then sell that, get that tax money to buy your next home, and then your next home, and then your forever home, and then your downsize home. So usually people stay in homes for like 5 to 7 years roughly. And then there's depreciation on a home. So that's another tax benefit. You can depreciate the building value over 27 and a half years. And average appreciation in the Bay Area for single family homes is roughly 4 to 5% per year. For condos, depending on which area, is a little bit less, but we'll walk you through what are the better options. And you have consistent monthly payments too, versus your landlord can increase your rent every year at a certain rate, 3, 5, 10%, whatever is allowed if you're in a rent controlled area. But then, yeah, in other areas, they can increase it even more. So luckily, Eileen, you have the family discount. Phil, you own your home already. So you probably have a good 30-year fixed mortgage. And then the equity growth, building equity over time there too. So I want to quickly introduce and pass over and introduce Assad. He's a partner of ours that we've been working a long time with.
Thanks, Jenny. Nice having both of you on here with us. As Jenny mentioned, I am with US Bank. I've been in the industry for about 20 years. I genuinely love what I do, working with first-time home buyers or move-up buyers. I know how stressful and complicated the process may seem. So just being a resource to help navigate you through that process really brings genuine happiness to me. And helping find the right product out there is also very important. There is a handful of products out there that buyers can consider. And once I get to know each person's unique scenario, I can navigate through the different options and recommend the best suited product for your unique scenario. So that's one of the things I really love doing, and look forward to getting to know each of your personal scenarios so I can better, provide more information for you. So as we go through the presentation today, we'll touch on a few points. Some of them is going to include the mortgage rate history, where rates have been historically, where they're at today. We'll go through the home buying process, talking about the pre-approvals, what different types of options there are in terms of getting pre-approved, the do's and don'ts of when you've actually applied for a loan, and how to get pre-approved. How much you can qualify for. So this is important. Think of it kind of like a credit card. When you get approved for a credit card, you get a high credit card limit. When you apply for a mortgage, you also want to know what your maximum purchasing power is. Doesn't mean you have to go that high. This way, you know what range you can work with. So that's one thing that's important for you guys to figure out, and I'm happy to run the numbers for you. Financing options, there's different down payment options out there, anywhere from 3.5%, 5% to 20%. So we can go through those different options and the pros and cons. We can go through strategies on what will help your offer stand out amongst other buyers and with the sellers as well. Closing and escrow process. So we'll talk about what escrow is, how to get your loan to close smoothly without any obstacles. And then building equity in your home, we'll talk about that as well. So historical mortgage rates. So historically, if we look at it, even with rates being higher than where we were during the pandemic, we're still at a pretty good level. As Jenny mentioned, there was a period where rates were 13, 15%. So the current rates are still historically at a competitive level. The rates that we had during the pandemic, that was kind of an anomaly. We may not see rates that low, but the sentiment is that rates will eventually come down. A lot of economists and analysts are indicating maybe in the next few months, we're going to see Fed make the first rate cut, and then eventually it'll trickle down and affect mortgage rates. Of course, we don't have a crystal ball. We can't predict exactly when or how much, but that'll give opportunity for new home buyers who may be locked into the current rate to refinance into a lower rate in the near future. And what's the most important is for you guys to feel comfortable about the process and hopefully get into a home. You're not locked into the rate when you purchase a home. You have the option to refinance the loan in the future when there's an opportunity. Most of these loans, they don't have any prepayment penalties. So what that means is that there's not going to be any cost or fee for you to refinance the loan, make extra payments, or when you sell the property to pay off the mortgage.
This is a quick chart regarding like inflation. So we are seeing inflation softening. So that's when rates are likely going to be softening a little bit as well. So we don't know, we don't have a crystal ball, but we think that it'll probably be in the 5s again. But we'll see. But what we always say is marry the house and date the rate. You can always like get a refinance and change your rate later on when it goes lower, but there's a lot more buyers when it is at a lower rate. And walking you through, is it a good time to buy? So we have a few different types of folks here. Eileen as a first-time home buyer. So we do see home prices have leveled off. So with an entry-level home, interest rates could potentially climb, but right now we are seeing that it's going to be pretty stable. So there's a good amount of inventory right now. Also, summertime is also when a lot of people go on vacation, and like a lot of people signed up for this call, but then they're like, okay, I will watch the recording because we're traveling. So less competition. We love like getting under contract right around holiday weekends too, because most people aren't there, and the homes that are still sitting, like you can get a good deal on. And repeat buyers and sellers who plan to buy again. So similar for Phil is you've gained a lot of equity in your home. And if you've built over $500,000 of equity in your home, I would say that is a great time to redeploy that equity into something else, or maybe convert that into a rental and then move into what I did was like did a cash out refinance, pulled some of the equity out, helped with down payment for other properties to be able to scale up my portfolio from a $1 million property to now owning $30 million of real estate across the country. So being able to think about that on an investment perspective, not just, hey, I want to own this home to live in. And right now, we've been able to negotiate good deals. Christine just got under contract for a client that it was initially listed for 1.39, and just based off of like timing and everything and the negotiations, we were able to get it under contract right under 1.3 million. So over $100,000 below asking. So it's not going to always be the case, but we'll walk you through as real estate professionals which ones we can get good deals on. And walking you through like the cost, rent, and savings analysis. So some people are like, hey, should I just keep renting my home? So if you're renting, let's say if you're probably paying low rent, but let's say on average, rent in the Bay Area for like a standard 2-bedroom home, like 2-bedroom apartment, was at least $3,000. So per year is about $36,000. And then if you're thinking over 5 years you're renting, that's $150,000 to $180,000, and it could keep going up every single year. That is going poof, going into your landlord's pocket. And then we're using a sample of like about a $1.7 million purchase price and what that would look like. Mortgage interest rates vary. They're right around like 6% to 6.5% right now. And if you're putting in about like a 20% down payment, what this would look like insurance wise, property taxes, roughly about 1.25% of your purchase price in the Bay Area in most cities, except for some of the East Bay cities is about 1.388, 1.4%. Appreciation, we see about 5%. Insurance is also something we want to be cautious of too. Right now, insurance is a little bit higher in fire damaged areas or fire zone areas, but we're seeing about $200 a month or so for insurance. And if you were to rent, what you would lose out on is the money that you're paying towards your landlord. We say treat the money you're paying like paying towards your house and your mortgage as a piggy bank. You're going to get that equity and such and the tax savings back later. And then appreciation. So on a $1.7 million home, about 5% appreciation is going to be $85,000 per year. So if it's just $1 million home, that's $50,000 of appreciation that we're losing out on. And then property tax savings, we mentioned $10,000 per year. And if your tax rate is about 35%, you can deduct $3,500. And then mortgage interest is about 15 to 20,000 that you can deduct also. So that's another tax savings that you'll get. So yearly cost to rent is close to $140,000 of value that you're losing out on of tax savings and what you're paying to your landlord. And monthly is going to be 11,000, 12,000. So even though you're only like, you might think that you're paying $3,000 a month in rent, but in actuality, the opportunity cost is going to be a lot higher versus like what your monthly will be with your principal and interest, taxes and insurance will be closer to $9,500 or $10,000 per year. So still a little bit less than what you would be paying on your for the loss of value on the opportunity cost and rent. So let us know, Eileen, Phil, if you have any questions on that. I know I just threw a lot of numbers at you. So this is a home buying process, and we start off with meeting real estate professionals. So we would be honored to work with you both. Christine and I have helped hundreds of different clients over the past few years, and just really understanding someone who is like a full-time real estate agent is going to be important because they're going to be fighting for you in the market and knowing what's going on. Getting pre-approved with a lender such as Assad, he has the best rates, low closing costs, and can close very quickly too. So I've used Assad for many of my loans and very much highly recommend him. And he's just got into a contract for another client of ours too. Then the fun part happens. That's where Christine and some of our other team members come in. That's the search for homes, like showing the homes, knowing what you're looking for. And what we do is like point out what might be wrong with the home so that that you know, okay, what are their costs or what are the additional expenses you might have to look out for. And then putting in offer, we'll walk you through the offer process and then the negotiation, going back and forth. Christine went back and forth like 2-3 days of negotiation, but got the price that they want for the clients, and then escrow. So this is where we connect you back more so with Assad, and he handles the escrow. So that's where he can fund and close in the 21 to 25 days. And then final details, signing off and giving closings, such as the previous clients in the photos, giving a nice, nice basket and such. And I'll go ahead and pass it back to Assad of going through the pre-approval.
Thanks, Jenny. So pre-approval is really important because it's going to help give you guys confidence when you're out there looking at homes. If you have a really strong pre-approval and we do a lot of the legwork ahead of time, once you get into contract, as Jenny said, it's just going to be smooth sailing. I don't want you guys to worry about chasing documents at that time. I want you just to plan your move and be excited about it. So what is needed for the documents ahead of time to get a very strong pre-approval? These are some of the items, and we'll touch on it. The first one is documents related to the assets. So 2 months bank statements, brokerage statements, or retirement account statements. This is needed because the lender wants to see where the money is coming from for the down payment, closing costs. And there's also something that's called reserves that some programs require. I'll touch on reserves quickly. Reserves is an emergency fund lenders want to make sure that you have to fall back on in case something happens with employment. Reserves have to be your own personal money. It cannot be gift money. So that's the purpose for needing the 2 months bank statements. We need all pages with no redactions on it. In terms of the brokerage account, equity positions, those don't need to be liquidated for the pre-approval. You can hold them as is in their equity form, and then you can sell them once you get into contract. So the next item are the pay stubs. So we'll need 2 recent pay stubs to confirm what your current salary is. And that's what we'll use for your qualifying income. It's your current salary. We're not going to typically average your base salary over the last 2 years. We'll just look at your 2 current pay stubs. Okay. Tax returns, that's needed for borrowers who are either self-employed or if they own rental properties. If you are a wage earner, W-2 only, working for a company, we won't need your tax returns. Valid ID is just needed for closing. When you meet with the notary, you'll need to present your ID. The earnest money. Earnest money is the initial deposit that you make as soon as your offer is accepted. It's a deposit that's made to the escrow title company, and it's part of your down payment as well. Typically, it's about 3% of the purchase price, and it's held again with the escrow title company, and it'll be applied towards your down payment. So that also goes towards the asset piece of it. Your bank statements will need to see where the earnest money came from. Mortgage statements, if you currently own property, we'll just need copies of the mortgage statements, as well as any other statements related to the property, such as property taxes, homeowners insurance, because we need to get a sense of what the expenses are that you have. And then if applicable, award letters, what that refers to is if you get cash performance bonus or restricted stock unit income. It could also refer to alimony, child support, disability, things of that nature as well. Divorce documents, bankruptcy documents, retirement statements, and then US residency documents if you are on a work visa or a green card holder. All right, so what do lenders consider when you get pre-approved? There's a few categories that we look at. This first page over here is going to touch on your income and your debt and your credit history. This category also impacts your purchasing power, how much you can qualify for. So the first area, the income. We're going to look at your current base salary, and then if you have a 2-year history of receiving bonus and restricted stock unit income, we can use that as an income source for you as well. If you have rental properties, we'll look at your tax returns to use rental income. Or Phil, for example, I think I caught earlier in the call mentioning that you currently own a home and you potentially are considering to upgrade. So in your current home, we can potentially use rental income on that as well. It's called a departing residence rental income to help offset some of the expenses. So there's a few different categories that we can use for income. Now, in terms of debts, what we look at are going to be anything that's on your credit report, essentially. That's how you want to think about it. For example, student loans, auto loans, credit cards, whatever the minimum payment is, that's going to be the debt portion. And then to that, we're going to add your projected housing payment for the new home you're going to buy. So whatever the mortgage payment is, taxes, insurance, and if there's an HOA. So essentially think of this as a fraction. It's called the debt to income ratio. The numerator, the top portion is the debt, and then the bottom portion is the income. And there's a max debt to income ratio that our products can go up to. It's anywhere between 45 and 50%. The higher you go up to the debt ratio, that's going to define your maximum purchasing power. Okay. And then in terms of credit history, we can pull either a soft credit check or a hard credit check. If we do a hard credit check, we'll get all 3 credit scores, and we'll use the middle of the 3 credit scores to base your qualification and your interest rate. All right, so next category that defines your purchasing power. So we talked about your income, your debts, the debt to income ratio. Those all impact your purchasing power. The other area is going to be your assets. So how much you want to contribute from your portion for the down payment. That could also be the limiting factor in defining your purchasing power. So whether that number is 3.5%, 10%, 20%, that's something we would discuss, and you let me know what you're comfortable with, and then it can help us calculate your purchasing power. The money for the down payment can come from either your personal accounts. It could also come from gift money from family if you have that as a resource. As long as the gift money is coming from the donor's account here in the US, it's a very seamless and easy process. The money doesn't need to get deposited right away. It can get deposited once you find a home as well. Let's see, additional. And then for reserves, we briefly touched on that already as well. The reserve does have to be your personal money. The amount of reserves depends on which loan program we do and how big your loan amount is. And finally, the property, that is going to be indicative of the market value. So when you purchase a home, you got to say, for example, you get into contract at $1 million on a home. The lender wants to ensure that that's what the property is worth to protect themselves as well as the buyer. So that's where the appraiser comes into play. The lenders work with independent third parties, so that way the loan officer and also the potential buyer can influence the value of the property. So an independent local appraiser will go out and do their inspection and provide an appraisal report.
And a great tool to use is just Google the Zillow mortgage calculator affordability. We also have the link here. Christine will put it in the chat. But if you want to figure out, hey, how much can I pre-qualify for initially without talking to the lender? So you put in your annual income and Assad, how much would you say like account for RSUs? So let's just say like your base salary and then only maybe 50% of your RSUs, just because it could be very volatile. So let's say if you're making 200,000 and then 100,000 RSUs, we sometimes say 50,000. And you can also chat with Assad to get more details as he goes through your underwriting. And then monthly debts will be any car loans, student loans, and reoccurring credit card debt that you don't pay off consistently, like the child alimony support. So this potential buyer just has like a $250 car loan that he has and 250,000 for a down payment. And then debt to income ratio, Assad can go up to 45%. So comfortably, this client can go up to 1.25 million for a purchase price, but probably can go up to 1.4, 1.5. Property tax is 1.25. Interest is about 6% plus or minus. If you want to buy down points, you can get it for less. And insurance, we mentioned about $100 to $200 per month. And then if there's any HOA. So it's a great fun tool that you can toggle and play around with to see your monthly payment.
All right, so back to me. Loan programs. So there's a few different categories, or actually two main categories. There's something that's called conventional. There's some other words that are very synonymous to it. You might read online or hear about conforming or agency. It refers to a group of mortgage products that essentially all banks and lenders have access to. These are programs that are serviced by Fannie Mae or Freddie Mac. They have a maximum loan amount of about $1,149,000 in the Bay Area. So that's one of the groups of products, and there's certain pros and cons to that product as well. And then the second group of product, if your loan amount is going to go over that, is going to be our portfolio / jumbo product. And the best way to describe that is that it's the lender's own product. So for example, US Bank has their own portfolio product because the bank creates their own guidelines. It's not based on Fannie Mae or Freddie Mac. US Bank creates their own portfolio guidelines. They lend their own money. And then when the loan closes, it stays with US Bank. So you're going to always end up making the mortgage payments to US Bank. Guidelines are different on the portfolio versus conventional. And as I mentioned, each have pros and cons. Every borrower's scenario is unique. And it's my job to find out what your unique scenario is and give you options and recommendations based on that. And then the first-time homebuyer programs. There are some first-time homebuyer programs out there that could offer slightly lower interest rates if you qualify. A lot of them are income-driven. So for example, just to give you an idea, if you're looking to purchase in San Francisco County or San Mateo County, and if your income is below $190,000 per year, then you can meet the conventional first-time homebuyer program guidelines. What it does is it waives certain rate adjustments. So you'll get a better interest rate versus a borrower who is not a first-time homebuyer and they don't meet those income requirements.
And I love working with Assad because like I've had a loan before him and they kept selling the loan and went off auto pay and got derogatory remarks because they kept on switching companies. So I'm glad that we can just keep everything with US Bank with you.
Yeah, definitely. Thank you. All right, these are the top 10 do's and don'ts. Before I quickly go through the list, the main thing for you guys to remember as home buyers, whenever you start the pre-approval process, is anytime you're going to anytime you're going to make a major decision at that point, definitely communicate with your real estate agent and loan officer before you do it. And that's what essentially this list is telling you. What are some of the common things that you need to talk about to your realtor and loan officer before you make those decisions. So for example, applying for any type of new credit, because that's going to hurt your credit score, and it could also increase your debt to income ratio, which would impact your purchasing power. Keep all existing credit card accounts open. Closing open credit card accounts will potentially lower your credit score as well if you're doing that right before you're going to apply for credit or have your credit checked by the lender. Don't max out your current credit cards. The higher the balance on your credit cards, then the likelihood of your credit score dropping is very high as well. So you want to keep your balances as low as possible, ideally around 15% of your high credit card limit. Do keep your employment within the same company and within the same field of work. If you have to change, definitely talk to your realtor loan officer. And I have had clients change in the middle of the process. One thing that I think kind of unique with the US Bank is that we can use just an employment offer letter instead of a pay stub, and we would still be able to qualify you for the loan. But it's always good to bring that up as early as possible. No surprises. Don't consolidate debt into one or two credit cards. And then these are some do's. So if you do have any collections, judgments, or tax liens, pay those off as early as possible. Do be prepared to pay off collections in case it's required by the specific loan program or by the underwriter. Do provide any documentation for satisfied judgments or past tax liens. Do stay current on payments for all existing monthly obligations. Do call us before making any financial decision or changes to your normal routine.
The fun part, Christine will go over.
Hello. So for touring homes, we love to be part of that just to be able to keep you safe as well. Our team has caught, even if like not in the disclosures, we have caught like horizontal cracks in foundation and, was able to mention that. And it's all for negotiation purposes, as well as making sure that the home that you choose, like there's no surprises there, right? So our goal with touring these homes with you is to keep you safe and make sure that you know of any future repairs that may need to be made, because those things, you have to save up for. So some questions we ask is, where do you want to move to? What kind of home are you looking for? How many bed, bath do you prefer? What are your preferred modes of transportation? Are there schools you want to live in nearby? And what are your future goals? What cultural traditions and beliefs are important to you? We do take all of those into consideration, and more than just your just average questions, because I know everyone has the preferences. Like some people need to have a lot of natural sunlight in their home or can't be on a T intersection. So yeah, we look within those bounds. And we also ask, what do you look for in a neighborhood? Because maybe you don't know all the neighborhoods around you, but would end up really loving some, right? And we do also like neighborhood exploration. As we're looking at a home, we'll take time to maybe go to the local coffee shop, or I'll walk you through the local downtown, and we'll be able to actually like tell you more, so you get the local feel too. Because sometimes like maybe looking at the neighborhoods, can be limiting, right? And there are three main contingencies in the Bay Area. There's the loan contingency that's based on, Assad will help you out with that, based on like what you're pre-approved for. And we always go back to the lenders before offering as well, just to make sure there's not going to be any issues. I know for some that have HOAs, we always want to make sure that the lender can lend on it. So that way they can look in their system too, because some of that information is not easily found in the disclosure sometimes. And if you can't lend on it and we go into contract, then that would be an issue, right? So we do a lot of background check. Again, our main goal is to make sure that we keep you safe and no surprises. So we would check in with Assad, like, hey, can you look at this address? Is it lendable? He'll check. And once he gives a thumbs up, great, then we're clear to offer on the home. But yeah, in case of any loan contingencies, that you would always refer back to your lender on. And for the appraisal, that is when and we're always going to show you the comparables, meaning similar homes that have sold in the area, and see what the pricing there is. We will look at the pros and cons, like, oh, like this home sold for this much because the square footage is almost double what ours is, or the one that we're looking at, or the renovations, how renovated is it? Obviously, a home that's sold as is from the 1950s is gonna be selling for a very different price than one that was just renovated in like 2024, right? And we look at a lot of other factors to make sure to protect you and make sure that there's no appraisal gap. And that way you'll have an idea of where the home could go for, like based on that research, that market research as well. And we'll go from there. So that way you're not just going on a bidding war just to bid just because you can, right? We want to make sure that where we offer makes sense. And we're not just bidding blindly. So there is the appraisal contingency to make sure that if for whatever reason there is any concern, then that it won't appraise, like we will let you know, right? But majority of the time, we will usually get the home like close to market value. And if there is, for whatever reason, you are wanting to offer above market value, then you will know about it too, right? If you really love the home. And the inspection contingency is, we have seen times, it's more rare than not, because usually inspection companies being a third party, they are pretty thorough, but we have seen times when the inspection report is so vague where it didn't really tell us much about the home. Maybe there were lots of places where it said could not inspect because there was something blocking the entrance, or they weren't really detailed with it. Those are times where we may recommend coming in with an inspection contingency, or if there are some inspections that weren't done, then we would recommend coming in with an inspection contingency. But all of these, we will let you know if we recommend any contingency with the offer. I will say in the Bay Area, over 90% of offers come in fully non-contingent, just because, again, inspection reports are already provided, and we will do all the research for you based on where the home value would go around. And loan part, that's where you talk to your lender if there's going to be any issues or not. Go to the next one. Great. So main inspection reports to look over would be anything that mentions electrical or plumbing, anything electrical, like let's say it's knob and tube, which is very old. There are some insurance companies, at least the main ones, that won't insure on it, or if they and the ones that do may charge a premium on it, right? So we always look at that to see okay, how much is it going to cost to change out the entire electrical, and we'll look at is all of the entire home knob and tube, or is it partial knob and tube, and be able to get you quotes that way too. We do work really closely with our contractors, so we do have a good general idea of how much work will cost, because these are all factors that you need to take into consideration, right? Same with plumbing, if it's galvanized pipes, a lot of insurance companies will not insure on galvanized piping. So we will look into all of that for you too and provide quotes. And other reports has to do with termite and fungus. Anything that's Section 1 work would be work that you want to get done within a year period. Anything that's Section 2 is more so it can wait a little longer, but the Section 1 work would be more immediate. And we'll look back at how it has the numbers. We'll go back to Section 11B and read what that is, 11A and read what that is, and be able to also let you know okay, this is gonna take care of it, or a lot of times it's all quoted out. I will say in the Bay Area, normal Section 1 work is anywhere from $2,000 to $10,000, and that's average. And I know a lot of first-time home buyers, Eileen, maybe those numbers may be intimidating for you. Maybe you'll be oh my gosh, 9,000, that's too much. But actually that's still within normal, reasonable range. And we don't want you to miss out on your dream home just because you freaked out on something that a more like experienced home buyer would see as normal, right? So we'll let you know what's normal in the Bay Area. Obviously, since we're surrounded by water, it does make sense that there's going to be a lot more fungus and dry rot areas. We'll go through that. And for natural hazard, so this one, we do extra digging for our clients. We don't just take this at face value. Of course, we'll let you know, like special flood hazard zone, you are going to be required to get flood insurance there. And we'll even help you like introduce you to some more competitive insurance companies with their rates. But we've noticed like some places in the hills, like San Carlos Hills, Belmont Hills, Burlingame Hills, those areas, it may, some of them, especially towards the bottom of the hill, if they mark no for fire hazard, we actually have learned that that doesn't necessarily mean you don't need fire insurance. So we do call insurance companies and actually like make sure to get the okay from them. Hey, is this actually like completely clear of fire insurance? And there are definitely times, especially now with insurance being like the Wild West, where they're like, actually, no, this is a 6 out of 10, a 6 fire zone. So you will need fire insurance, and that can range in the couple thousands. So those are just one of the ways that we do keep you safe. And again, like no surprises there too. For writing a winning offer, this is what we do best. And just so I know, I don't know, Phil, if you were here for that portion, but we are actually part of the top 1% in the Bay Area, meaning that, you know, big difference between us and a lot of other agents. It may take your average agent 7 to 10 offers with them before they get your offer accepted, but we usually get our clients' offers accepted in 1 to 3 attempts. And a lot of that is because we coach them as well. And we make sure that our offer stands out, and we prepare more than what majority of offers come in at. And in this hot market, you know, we love to make a great first impression. It really matters having a great relationship with the listing agent. Like the listing agent I spoke with today, where we just got into contract earlier today. I literally, he's right by our Burlingame office. So I'm like, you owe me a drink. And even though we actually ended up getting a good deal, I made him feel like he won this one. And that's a lot of like how it's all about the impression and how you leave them feeling, right? So he's actually buying me a drink for us getting a good deal on this one. But yeah, always just good relationships. You never know who is you always want the listing agent to fight for you. So we always try to leave like good impression, where a lot of repeat agents that we work with always tell us like, oh, we love working with your team. We love how organized you guys are. And the way you guys set up your offers is so beautiful. Because I will tell you, like offers, everyone does it so differently. And a lot of times they are kind of disorganized. So we try to make it really easy, cut and clean. And that's a lot of the feedback we get from listing agents too, and why they fight harder for to get our clients' offers accepted too. So we also determine how motivated the seller is. We want to make sure like, oh, is the seller, did they already buy their next house? Like, so they have to sell this home, right? So they're a little bit more motivated than a seller who is like, oh no, like they just moved in with their parents, or, you know, they aren't really, they don't need to sell this house to get their next house. So we try to determine like the seller motivation, and especially if it was a home that was really loved, right? Then we'll make sure that our clients write a love letter to the seller, make it more personal about how much they love their home and how they see themselves growing a family here, and really just pulling at the heartstrings relating to the seller versus just an offer that's all numbers, right? And for offer seller leaseback, a lot of times there, like I mentioned earlier, there are times where sellers may need a transition period. So more than that 30-day escrow period to just, you know, find their new place. And so that would be more of like a rent back, if anything, where maybe we agree upon 20 days after close of escrow. So a total of 50 days if escrow was 30 days, where you're giving them more time to make that transition versus someone who maybe just didn't do their research, right? And just offered the typical 30-day period, right? Little details like that really help to push the envelope to have us stand out and be the more obvious choice. And that's what we always try to be, is the obvious choice of like, and the most convenient compared to every other offer. So for the contingencies as well, if for whatever reason the inspection inspection contingency, let's say we come in with that, we do make sure to call the inspection companies to see how fast and find a company that can do it in a really short period of time, maybe same day or next day, right? To be able to do the inspection. So that way we can, the average inspection day for contingency would be like 10 days, but maybe we can have it done in 3 days or 5 days, right? Little things like that really do make our offer very competitive, especially if there's other offers that are coming in with this like really similar to ours. But yeah, and I won't say like just one of these win the offer, but it's a culmination of each of these. And we have like additional strategies we use on top of this that help our clients to get their offer accepted. Yeah. I'm going to pause here. Do you guys have any questions at all?
I don't have any questions at the moment.
Okay. Is this information helpful?
Yes, it's been.
Okay, great. Glad to hear. Great. And offer requirements, we will have a pre-approval letter that you'll get from Assad and your proof of funds as well. So basically your statements, your RSUs, anything where you have any liquid cash reserves too. And then that's where you would include like a gift letter from family or so. Wherever you're getting all your funds from, and your offer documents, signed disclosures. Again, a lot of that we will draft up for you. And if you sometimes want to go line by line, I know some people, they want to know, and they should know exactly what they're signing. We will go line by line of what each document means too. And of course, the additional love letter. Again, love letter, it doesn't work every time, but we put it in because there's a chance it could. Right. We've had times where we represented buyers. They were the third highest offer, and we still got their offer accepted because they wrote such a great love letter and they made the sellers tear up. For the offer process, once your offer is accepted, we'll also hold your hand through that process to, we have a whole checklist in our spreadsheet that we personalize for you, where we make sure that you know what steps you need to take, as well as what steps we're going to take as your agents, such as we're going to meet with the appraiser to make sure that they're looking at the comparables that we're looking at. So that way there's no appraisal gap. And if anything, maybe we can even get you a extra equity. But yeah, and for title company, they receive the residential purchase agreement and open escrow. And then as Assad mentioned too, you're going to send the earnest money deposit day 1 of escrow. So the day that your offer is accepted is day 0. And then day 1 of escrow would be the very next day, wiring 3% of the purchase price. And then we'll go ahead and Assad, like if you go with him as your lender, we'll order the appraiser, we'll meet them in person and make sure everything goes smoothly. Sometimes we'll even bring them donuts, because who doesn't love donuts, and coffee. And then we'll introduce you to some, and of course, feel free to do always additional, but based on what a lot of our clients end up going with, we usually try to introduce a minimum of 3 home insurance options. So that way you can always compare, right? And from there, lender buyer receive the appraisal report. And once, majority of the time, we're going to appraise at value. And again, if it's any different, you will know about it. And for buyers, they submit any required documents to the lender. A lot of times you'll meet with the mobile notary, where you may sign a pretty thick stack. They can meet you at work, at home. We've had clients in Japan and we got them a mobile notary. So we're going to make it work, right? And from there, we can, for buyers, we'll confirm the wiring and wire instructions. We will make sure that you are constantly calling on the phone and just making sure that there's no wire fraud, right? And for buyers, they're going to perform the final walkthrough of the new home and we'll be there with you. Then title company will send the signed loan documents to the lender for final review, and lender will wire the remaining funds to the title company. Then title informs the title company, or sorry, informs agent of the title of all the documents. Then buyers to transfer utilities. That's towards the end. You can do it within the first week before close of escrow, where you start to transfer all the utilities over. So that way nothing gets shut off. But you do still have, even if it's like the day of close of escrow, you do still have a few days to transfer it over, but we always want to make sure to do it sooner than later, just for peace of mind, right? And then from there, the agent, we will reach out to schedule a time to meet and deliver the keys to your new home, and we'll celebrate, and it'll be just a victorious win. So yeah, these are some of our closing celebration photos. We love to, also customize like a home watercolor. We have an amazing watercolor artist, and down in the corner, we'll even celebrate holidays with you. Those are some of my clients down at the very bottom right-hand corner, where they don't normally celebrate Halloween, but I was like, we closed on Halloween. Heck yes, we're gonna dress up. So that was their excuse to dress up for the day. Yeah, and yeah, thank you guys for taking time to go over this and allow us to share some strategies that help us to win for our clients. And we'd love to take any questions. Great.
Hi, this is Phil. I have a couple questions, and thank you very much for this presentation. They're very useful. These questions might be for Assad. So first question is, how long is a pre-approval good for?
Yeah, that's a very good question, common question I got. It's good for 3 months, but your credit report is good for 4 months. The reason there's a disparity between the two is that the loan application falls off of our system at the 3-month mark, but your credit report is still valid. So for us to keep it valid for the complete 4 months, you'd have to restart a new application, and then I'd be able to reissue that original credit report.
Okay, and I think you might have mentioned it. So in order to get a pre-approval, is it a hard pull or is it a soft pull?
We have both options. I always recommend the hard credit check because it helps us put you further ahead in the loan process, meaning that I could collect all the supporting documents that I know the underwriter is going to need once you get into contract. And then we can actually move your file to underwriting for the underwriter to sign off and clear all those conditions. So a lot of the legwork is done ahead of time on the pre-approval stage. So that option is there only with a hard credit check. But if you're in the early stages and you think your timeline could go well beyond 4 months, we can always start with a soft credit check. And at any time that you feel comfortable, you're ready, we can transition it to a hard later.
Got it. Okay, thank you. And my second question might be for you or Jenny. So Jenny mentioned, so I have a home that has some equity and possibly maybe using that. But what happens if to my original loan that I have on the home that has pretty good interest rate, would I give that one up, or is it another loan on top of that one?
So great question. So if you decide to keep the home, then you can keep that rate. And what you can do is possibly get a home equity line of credit as a second to pull out that equity to put for a down payment for the next one. For me, like I did a full cash out refinance instead of getting a HELOC because rates were about the same at that time of what I initially had. But if you have like a 2.75, you don't want to give that up. So just get a home equity line of credit you can get up to 400, 500,000 with certain banks. And then that can go towards a down payment. But let's say if you do sell your house and buy a new house, unfortunately, you will lose your loan rate.
Got it. Okay, thank you.
You're welcome. Eileen, any questions?
I do have a couple. Thank you so much for the presentation. That was very helpful and especially calming my feelings of like distress. So seeing the benefits of it too. One of the questions I had, I guess because I'm not familiar with it, but with my friends, there's a couple of my friends that are also either went through buying their first home or they're in the process right now. But it sounds like a lot of them, because I know a big portion of it is having that money available for the first down in order to buy the home. Um, is it usually, do you usually see it that it's best to have that money in cash, or there's still a possibility of getting that home even though the first down payment is like through a line of credit?
Hmm. Yeah, great question. So there's two different terms of cash. So it's
Mhm.
physical cash of
Yeah.
like Asian parents, money under mattress, banks won't see.
Yeah.
So
Yeah.
not that, but with other cash, so for a home equity line of credit, what we've seen is like leveraging someone else's like home equity line of, um, you don't have to liquidate it right away, but we've helped people purchase properties where their it came from a down payment from their HELOC, as long as you're able to still qualify to have the, like, let's say for Phil's case, he would have his current loan mortgage at his sub 3% rate, maybe a HELOC, and then get a new loan purchase. But there's something called debt to income ratio, that the max debt you can have, let's say with the SOD is 45 to 50%. If he makes $20,000 a month, the max debt he can have is $9,000 to $10,000 a month, from what the monthly rate and mortgage and everything, property taxes from the mortgage, the first mortgage, property taxes, and the new mortgage. But we're also going to add the potential departing residents of the rental. But like as a first-time home buyer for yourself, is if you're able to leverage a HELOC from like a family member, for example. That's what I did. It just came in as a gift fund. It was a gift from my parents, and lifetime gift currently is $13.1 million. I think they're going to adjust it down to 6 million from parent to child and such. So I don't think you're going to get 6 million right away. That'll be really generous of your parents, but usually it's a few $100,000 for the down payment gift from like the HELOC. And then over time, I ended up paying back my parents for that HELOC and paying it out. But yeah,
That's very
exactly what I was going to say to Jenny is you could structure it as a gift from family. When you mentioned using a line of credit, was it potentially a home equity line of credit on your parents' home?
Yeah, because when Jenny mentioned or like shared her real estate investment journey, I thought that was helpful when she talked about the HELOC. So, and I've also heard how just because how difficult it is trying to get a home in the Bay Area, that that's also like one option, but I didn't know the terminology.
Yeah, no, that's a perfect thought process you have. So yeah, you could leverage it just like Jenny did, and it would be structured as gift money, so you wouldn't have to worry about it impacting your debt to income ratio since it's not from your personal credit.
Yeah, you just can't leverage that money towards your reserves. The reserves, let's say you need, your monthly payment is $5,000 and you need 6 months of reserves based off your loan, then you would need $30,000. So the $30,000 could be in your stocks account, your retirement account, or other accounts, but it has to be under your own name. A cash value life insurance under your own name would also count, because my brother actually he came from student debt, law school, wanted to buy his first house, and literally had everything was gifted. And we're like, oh no, he doesn't have any other money. But luckily we found out he had a life insurance policy that helped him with the loan.
And then there are some programs like the conventional. When I was mentioning there's pros and cons, one of the benefits on the conventional program, typically it does not require reserves as well. So depending on what your scenario is, your loan amount, if we end up doing conventional for you, you may not even need to document any reserves.
Thank you. And I guess the one other question I had, I'm not sure about this, but because of how like at least San Francisco, or like the area, or I guess the area that I'm thinking of is more of like what I've seen in like Daly City, kind of like Pacifica, San Mateo area, like the houses are about like a little bit over 1 mil. And then thinking of like that mortgage as a first time home buyer, do you have like ideas or from experience of you've heard of like ways people are trying to get passive income to help with those mortgage payments?
I think kind of what Jenny had mentioned early on in the presentation, what she had did was the house hacking, right? Where
Mhm.
I don't know if that would fit your family structure though, depending on what your goals are with starting your own family.
So there's a lot of homes like Christine just got one under contract where you can have like a 3-bed, 2-bath upstairs and an in-law downstairs, and have like a separate space for them and rent that out on like what we call furnished finders, midterm rentals to traveling nurses. And people are getting about $2,000 per. I have an ADU here in my house in Brisbane, and I'm getting $2,500 per month on ours, and our mortgage is $7,500, so it pays a third of our mortgage. So we have this beautiful total 5-bedroom, 4-bath house. 1 bed, 1 bath is rented out. So those are some of the considerations. And then there's also other homes with like detached ADUs that you can think about for that passive income. Some other clients of ours end up renting out their garage spaces for storage or other things for $300 to $400 a month. So so there's a lot of creative ideas that are out there, but yeah, just being able to get in the market early on, you're going to be able to reap the benefits long term. A lot of people are like, hey, how are people affording real estate? Because families like yours like have bought real estate over time, built equity, and they have cash in their equity. So that's how they're putting a lot down in like cash offers. Not everyone's cashing out in stocks or tech money right now, but
Mhm.
it's but yeah, great question there.
Thank you so much. That was all the questions I have.
Great. Well, thank you both, Eileen and Phil, and anyone watching the recording. And Christine will follow up to schedule a time for a one-on-one with you each to go into your goals a little bit more in detail. So walk you through the strategy to guide you, whether it's this year or next year that you're looking. And then Assad will do the same, going through your financial to ensure, hey, this is where you're comfortable and max pre-approval will be. Mhm. Well, have a great night, everyone. Take care.
You too. Thank you so much.
Thank you.
Bye.